HELOCs can be a great tool towards achieving financial freedom, but at the same time, if you lack discipline, it could be a financial trap. Look, you've got equity in your home and a lot of it. But did you know that your house could be making you money? Most people think HELOCs are just another loan, but that couldn't be further from the truth. If used properly, HELOCs could be one of the most powerful financial tools for homeowners. And statistics show that many homeowners aren't taking advantage of this tool. In 20 minutes, I'm going to provide you with over 30 years of experience to break down what is a HELOC, what are some of the pitfalls that you can avoid, and how you can use it to achieve your financial goals. Before we go into a deep dive, if you need a quick TLDR, go ahead and take a screenshot of this. Feel free to come back to the video when you have more time, but at the end of this video, we have two expert brokers who have worked on hundreds of HELOCs who will share their secrets and insights. Hi, I'm Peter with The Clear Close, and in this episode of our mortgage product series, we're going to go over HELOCs. A HELOC is a home equity line of credit. It's a revolving line of credit secured by your home. That means you're using your home as collateral in order to borrow money. It functions kind of like a credit card, but since it's backed by your home, a hard asset, you're going to get a much better rate than, say, a regular credit card. The limit of how much you can borrow is tied to how much equity you have in your home. Rates can either be fixed or variable depending on the program or the lender. Rates are also tied to something called a benchmark, like the Wall Street Prime or the SOFR or the LIFOR. Since HELOCs don't work like a conventional loan, there will always be a lender's margin attached to it. So for example, if Wall Street Prime is 7.5% and a lender's margin is 0.5%, you're looking at a total interest rate of 8%. There's also something called a draw period, where you have a set number of years to draw funds from the line of credit. Once that window closes, you're no longer allowed to draw any more funds, but you're still responsible to pay back the money that you've drawn from the HELOC. Which brings us to the repayment period. A lot of HELOCs allow you to even choose the length of time that you want to repay the amount drawn. It could be 5, 10, 15, or even 30 years. So the quicker you promise to pay, the lower your overall interest rates can be, but there are benefits to choosing a longer repayment period. Here are some common uses for HELOCs. Generally, you can use the money however you want. Home renovations, investments into other properties, or even unexpected medical bills. It's really up to you. HELOCs are a great way to consolidate personal debt, like credit cards. You can even use it on a vacation if you want, as long as you're able to make the payments back. Now, a common question from many borrowers is, what are the hidden fees? Every HELOC is structured uniquely depending on you and your factors that you bring into the loan. For example, your credit, the lender, how skilled your mortgage originator is. These are all factors that play into the terms that you get. And here are a list of the common fees. Quick rule of thumb. Always ask your originator for a line-by-line breakdown of the fees. Okay, so you're a smart consumer, which is why you clicked on this video in the first place. You're probably wondering, what's the risk? What's the downside? And what am I exposing myself to by opening up a HELOC? Well, just like any other loan, if you can't make the payments, you're going to go into default. And the underlying asset that is backing up that loan or being collateralized, which is your house, may go into foreclosure. If you opt for a variable interest HELOC, if rates rise, then your payments rise as well. Another thing you have to realize about HELOCs is that during economic downturns, banks may freeze or even restrict draws on HELOC lines. Let's go over the top 5 mistakes that homeowners make with their HELOCs and how you can avoid them. Mistake number 1, not borrowing enough. HELOCs are unique in the sense that you can set a line limit and draw to that limit. Let's say you have a project estimate and it's going to cost you $50,000. And let's say you qualify to borrow $100,000, but you're responsible and you're thinking, let's play it safe. And you set your own limit to $50,000, half of what you could have qualified for. And halfway through the reno, your contractor opens up a wall and surprise, you've got black mold and corroded pipes. Your costs have now doubled. Don't be that guy. Remember, You only pay interest on what you use during the draw period. So if you qualify for the 100, get the 100. Use 50, use 60, use 70, but you have that space in case of emergencies. And the bottom line is set the limit as high as you can, but spend within your ability to repay. Mistake number 2, misunderstanding repayment terms. A lot of borrowers don't realize that when the repayment period begins, you're paying back the principal plus interest. What does that mean? Let's say you get a HELOC for $150,000 and you use all of it to put in a down payment for an Airbnb that costs $300,000. So you're 50% in. The HELOC has a 10-year draw period, which is interest only, followed by a 20-year repayment period. So for the first 10 years, you're paying interest only for the $150,000 that you've borrowed. But on that 11th year, your monthly statement is going to look very different. And if you're not in a position to make those monthly payments by year 11, you could be forced into a default situation. Now, you can avoid the sticker shock by having an exit strategy or a plan before you decide to draw the funds. Is the income from your job able to cover the additional expenses during the repayment period? Or are you going to sell that property or do a cash out refi to pay down the principal? Which brings us to mistake number 3, not having an exit strategy. It should be clear by now that HELOCs is not free money. It takes money to make money, but the way that smart investors utilize their HELOC is no different than any other loan. You just have to understand the structure and then plan around it. One amazing strategy for wealth building is called the BRRRR, B-R-R-R-R. Buy, rehab, rent, refinance, repeat. Well, how do you get the first B? Utilizing the equity in your home through a HELOC could be the move that kickstarts your journey to becoming a real estate millionaire like Graham Stephan, Meet Kevin, or Grant Cardone. By now, you're probably excited and ready to click that link in our description and start your journey towards being a real estate millionaire and achieving financial freedom. But hold your horses. Check your credit before you apply, because mistake number 4 is applying with a qualifying credit score. Yeah, you heard me correctly. The lower your score, the less options you'll have for better rates and better terms. Just because you qualify for a HELOC doesn't necessarily mean you'll get every benefit of a HELOC allotted to you. The higher your FICO score is, the more options will be presented to you and better rates, leading to an overall lower cost of the HELOC loan. So if you're at a 640 and you just barely qualify for a HELOC, consider this. Take a month or two, boost up that credit score by 10 to 15%. That's going to get you way more mileage down the road when it comes to a HELOC and getting better rates and better terms from a lender. And finally, mistake number 5, not shopping around. When you're shopping for a car, do you pick the first car that you see on a dealer lot and say, give me that one? No, of course not. You shop around, you compare models, you compare dealers. Do yourself a favor, shop around. Compare our HELOC with others. Every lender is not the same. Every broker does not have access to every lender and every product. Ours is a fixed rate, no appraisal, no documentation, fully amortized HELOC that can be closed in as little as 5 days. There's a link in the description if you want to learn more. So as promised, I've invited Jason and Nikki, co-founders of The Clear Close, to share some of their personal stories with you. Hopefully these stories will add context to what I've been sharing and help you remember to avoid these common mistakes and pitfalls.
Yes, so Peter, when it comes to like HELOCs, right? I've had clients where we had unexpected loss in the family, and it was very important that we got the funds quickly because we had I had a client that had an emergency situation that started out as a medical issue and ultimately turned into a funeral expense. So it's as grim as that subject as it is, it's when I think back on it for that client, it's a stressful time. So it was stressful in the sense that it actually didn't work out because the person that was trying to qualify didn't prepare earlier enough in the process. Like if you know something's going to happen or you don't know it's going to happen, that's where a HELOC or a line of credit comes in really handy. because once it's ready for you and your wife or spouse, you'll have access to the equity of your home. But unfortunately for this customer, when we were trying to wrap it up, I found out as we were preparing to close that the main borrower with the income passed away, and not being able to get the HELOC for them. And that was actually the most like sad part of it, because it was to prepare so that the wife would have that emergency fund in case something dire happened in the near future, and it happened sooner than anyone expected. So that was one of the difficult loans I've had to work on in my career. Statistically, there are over 40% of the homeowners out there across the country that have equity in their homes, free and clear of any liens, right? But we have issues qualifying because their credit is not where it needs to be, because they just don't know. Like, they don't know that the minimum on a HELOC in this market is the 640 FICO score, and they get very close to qualifying. And I have a customer right now that I'm actually working with. They're at 637 FICO on qualifying for the HELOC program, and we're juggling paying down debts so that we can get the score up high enough. I can't granularly go into saying, hey, this is what you need to do for a specific trade line, but Experian, for example, shares on their websites examples of what FICO bucket will have a certain type of credit utilization. So typically, those that use higher amounts of available credit on their credit card, you'll see their credit card scores be under the 640 mark. So if you want to keep your FICO scores high, you want to make sure you keep the credit utilization low. And ideally, you want to be somewhere around like 25 to 30%. And then as far as being strategic with it, a little bit of homework on your end as a consumer could be to see which credit cards have the lowest limits.
I have like had that happen many times. Like literally, people pay down on their credit cards, a couple of credit cards, and wow, their credit goes up dramatically. As long as you don't have late on your credit cards or collections, your credit is just because of credit utilization. It's sometimes a very easy fix, a matter of changing the date that you pay the credit card company, because you could have a $500 balance on a $700 limit card, and you pay it on the 10th of the month, but your credit card company reports on the 5th of the month, so they're reporting that higher balance, and you changing the few days of when you pay it, voila, you get your credit a lot higher. It happens a lot.
Segueing off of what Nikki said, the general rule of thumb is if you can qualify for it and you can make that monthly payment and get that maximum HELOC amount, you take that. It's the amount you should take, because you never know. Like, you'll always have a cost overrun. So imagine going on like a home renovation. You don't know what's behind those walls. So until you take that kitchen out, you don't realize you have lead pipes, and then your whole house has to be repiped, and you budgeted $5,000 for that, and now it's a $25,000 project. And customers try to fix it by taking out credit cards on top of that, or personal loans, and then they're in a bigger mess. And it's hard to fix that, because then now your credit score is down in the 630 range or 500, and then we have to work on a 2 to 3 step process to fix that to get you out of that hole.
Yeah, I think some customers have a defensive reaction to when a loan officer says, "Hey, why don't you just go for the max?" Because, they know that loan officers are compensated based off of the loan amount. And so it might feel like, or it might seem like it's like a sales pitch, right? Do as much as you can so that I can get paid more. But we're mandated by law to work for the overall benefit of the client, not for ourselves.
If we want to make more money off of you, then we would let you like borrow 10,000 at a time, because then we'll be able to like redo that loan 5 times, 3 times over and make the money. But really is not that. It's more, headache later on to try to get you qualified when you don't qualify anymore. So no, it's actually the opposite. I have a customer that I've been working with him for a while, and we did a rate and term, we refinanced to a lower rate, and he's at like retirement age, and he's still working, part-time to kind of supplement some of the income, but basically he had a lot of equity in his house. And what we did is we cash out to the maximum, and he put just enough down, 20% down on one, so that the payment makes sense for what rent he gets. And then he went on to like a second one as well. And then now he's on his third. So it's with the HELOC, basically you're using someone else's money for your own good, right? Even though you're paying on it, but it's not hard-earned money that you actually saved, for 5 years for you to do this. You basically are able to get the HELOC in like 5 days to get the cash that you need. As long as you have the equity, you could be an investor, 3 times, 4 times over. And of course, you got to be smart about where you're going to invest, right? Because if you own a home in California, you can't just put 20% down on one property with your HELOC. You might have to venture out to, like what he did is he takes money from a high value market, which is like California, and he puts it into a more, lower value, and the rent there are pretty good compared to what you have to pay for a mortgage. So it absolutely worked out beautifully. And this story, like, it repeats itself. It definitely repeats itself many times over. I have a borrower that was like last year, in the beginning of the year. He's like, nope, I want to keep my payment low. I don't need it. I just need 40. I think it was like 45 because the minimum was 45, and he wouldn't go higher than that. And we got it through. And also he picked a 15-year. He didn't want to go to 30, even though I'm like, you could pay the 30 with the a 15-year payment, but you can never pay a 30-year payment on a 15-year term, right? But he was old school. Basically, he went and we got 45, and literally like 6 months or so down the line, he needed more. He needed just like 10,000 more. It wasn't even like a lot. But when I run it now, it's and it, we have to redo the whole loan, but his debt situation was different as well, because he also racked up some of his like debts off of like the renovation that he did. So then he has higher debt, and basically like even that 10,000, it was like so hard to get because no bank wants to go behind as a third name. Long story short, basically like for you to try, oh, I'll just get out that little bit more later on if I need to, or you didn't think that you needed to, and then you do, like just maximize on the amount of the HELOC, because the HELOC is like a credit card, right? If your credit card company offers you 20,000, are you going to tell them, no, just cut it down to 5,000. That's all I need? No, you leave it there so that you have the, if you never reach that 20,000 on your credit card, you never charge interest or payback on a 20,000. You're paying back on a 5. So again, you don't want to be borrowing money when you're in the dire need to borrow money, because that you never know if you're able to qualify. And a lot of times, with luck have it, you might come up with some kind of issue during the process and not able to capture that cash that you need. So with the HELOC, get the maximum that you can get out, so that you can avoid the same situation that my customer did.
All right. Awesome. Thanks, guys.
Thank you.
Now, if you're ready to apply, there are minimum requirements: 640 FICO, less than 50% DTI ratio or debt to income ratio, and your home can't be listed for sale. But who is this for? This is for you if you have a solid chunk of equity in your home and you want to grow your asset portfolio. You have a reliable income and a clear exit strategy to pay the loan back, or you're generally financially responsible, but you just hit a rough patch and you need a way to escape high interest debt. HELOC is not for you if you're a renter. Unfortunately, this product is for homeowners. But don't worry, we just made a video about non-QM that's perfect for renters. Also, a HELOC isn't for you if you don't really have a plan or an exit strategy how to utilize that money. And lastly, a HELOC isn't for you if you are not good with managing your own finances. HELOCs can be a great tool towards achieving financial freedom. But at the same time, if you lack discipline, it could be a financial trap. That's it for today. We hope you got a lot out of it and maybe even inspired you to start your journey towards financial freedom. Use our HELOC in the description. And if you want to see more content like this, give us a like, a sub, and let us know in the comments below what topic you want us to cover next time.